Connecting. Monch, thanks for getting it all ready. Mike, Bethany, how are you today?
We're great. How are you
Fantastic.
doing?
It's a nice day outside where I'm at. It's nice and cold and cloudy. How about you?
It's
Beautiful sunny in Virginia. Was I think about 80, 85 degrees today. So summer is just about here.
Nice. I like that. I didn't get to read it, but I saw a headline that said VA to roll out a temporary fix to the buyer agent commission problem. I haven't read it, so I'm excited to read it. I was like, damn, I need to get to that. You just reminded me about it because sometimes we talk about VA loans, right? And stuff like that. So,
yeah,
all right, but
same. We haven't had time either, but we are excited to hear more.
yes, I'm
That
like,
would be
what is
great.
this? What is this? Today we've got the two people here from AssumeList, and we're gonna go over some myths. Obviously, if you've been following us when we're talking to Mike and Bethany, it's been about assumable loans, and I've learned a lot along the way. In fact, I can have real conversations with my clients, thanks to both of you, which I actually didn't have before. And so you've educated me along the way. And that's why I'm excited to talk about myths, because sometimes people still believe certain things when it comes to assumable loans. In fact, uh, last week, I had a conversation with an agent that I was coaching, and she said, "Oh, yeah, assumable loans, they're really tough." And she went on a tangent. I'm like, wait a second, let me send you a link. And I sent them your link. I go, I don't think you fully understand this because I didn't. Uh, so look, number one, thank you for creating this. And number two, let's get right into this. You guys ready?
We're
Let's do
ready.
it.
Awesome.
All right. Number one, I've got them written down here. Number one, only veterans can assume VA mortgages. True or false?
False.
False.
False. Yeah, we didn't
That's
want
Go
to
ahead.
bury the lead.
that's a big one because I had that assumption until you answered that one for me. So explain that to me, please.
Yeah, so any qualified buyer can assume a VA loan. It's not based on having been a veteran. Now, of course, you have to be a veteran to get the loan in the first place. To originate the loan, you have to be a veteran. But to assume a loan, you just have to be a qualified buyer. You've got to meet the servicer's, financial standards, as far as credit and income, assets, and all that. But you could be a civilian, never having served in the military, and still be able to assume that loan. Now, there is a caveat. It's just something to be mindful of. It doesn't make it impossible. It's just something you have to be aware of when you're looking to make an offer or looking for properties with VA assumable loans.
Mhm.
That assumable loan for the VA has got to be tied to somebody's VA eligibility. So when you get a new VA loan, it's your VA certificate that allows you to do that. That the fact that you served as a veteran and you have that eligibility, it ties into your loan and allows it to be guaranteed by the VA. So if the person assuming that loan does not have their own VA eligibility, it means the current homeowner, the seller with the VA eligibility, has got to leave a portion of their eligibility with the property in order for it to continue to be guaranteed by the VA. So it definitely doesn't stop you as a non-veteran from still buying it, but obviously, you've got to find a seller where that makes sense for them. And this can happen in a lot of cases. Obviously, if that seller needs to move really, really fast, if they need a 3-week closing and they're going to go use their VA eligibility to buy a house, next month in their new duty station, that's a tricky one, right? Because they probably need all of their VA eligibility to do that. But if that veteran, say, is moving overseas, or if they're not planning to buy again, or they've already bought using a conventional loan and they don't need their eligibility, it's a lot of times it's not a hardship for them to leave a portion of it behind with the home and allow that non-veteran to take it over. And that would continue to be the case. Their eligibility would be tied up until the assuming borrower sells the home someday down the road. So that's the only thing to know. If your seller's a veteran, make sure they understand how that works. Make sure it makes sense for them. But on the buyer side, make sure that non-veteran buyer knows, okay, we can do this. We just have to find the seller with the right circumstances, and we'll have to have those conversations up front.
Can can a new person trying to buy the home that has been assumed already, assume that loan, and can it keep going?
Yes. Yes. Assume there are multiple assumable properties, or an assumable property, once it's assumable, remains assumable indefinitely. So the right to assume a loan does not change based on the fact that it has already been assumed. So that new
Does,
buyer can sell the home and have the third buyer come along, or a subsequent buyer come along, and that subsequent buyer can also assume the loan from the first buyer who assumed it from the original owner. So you can daisy chain.
all right, so
Yes.
hold on. Question then, because I didn't know that. Thank you. Does when you're assuming a VA loan, does the person that left that, what would I guess the VA loan, right?
Entitlement.
Yeah, to the entitlement, do they have to be notified that it's being daisy chained again? Do they have to give approval? No, it's done.
No, no. They don't
Oh,
have any say in that property once they relinquish effectively, they're relinquishing their rights to their eligibility, or at least a portion of their eligibility. So that they may not know, let's just say the buyer who assumes that mortgage sells it 3 years down the road. That
mhm.
original owner, if they left their eligibility, they may not even get notified that their eligibility has been reinstated. They would just need either to look up on the VA website that their eligibility has been reinstated, or they can certainly reach out to any lender, and a lender will pull their certificate of eligibility and know that their eligibility has been reinstated.
That's
Three
cool.
ways for a seller's eligibility to be reinstated if they allowed a buyer to assume their mortgage and left their eligibility with that property. So one, that new buyer can sell the home. So if the new buyer sells the home, that original seller's entitlement gets reinstated. Two, that new buyer pays off the mortgage. Or three, that new buyer refinances. So if any one of those three occurs, that original owner who left their entitlement would have their entitlement reinstated.
Got it. Makes sense. Makes sense. This is why I love talking to you guys. See, I didn't know
Yeah.
that. I didn't
Yeah.
know
The
that.
trick with VA loans is that somebody's entitlement, whether it's the buyer or the seller's, a veteran's entitlement must be with a VA loan at all times. So there's no way to disconnect a veteran's entitlement from a VA loan. That's a requirement. So when a buyer comes along to assume a VA loan, you can either just one of two ways that can occur. Either the buyer has their own VA eligibility, in which case it's called a substitution of entitlement, SOE. And during a substitution, the buyer's entitlement replaces the seller's, and the seller has their entitlement reinstated. They can use it for a future purchase. The other way is the buyer maybe doesn't have entitlement, or if they are a veteran, maybe they have their entitlement tied up in another property. In that case, if the seller is willing to leave it, then the buyer doesn't have to be a veteran, and and the seller is willing to leave their entitlement, the buyer can still move forward and assume that VA loan.
Got it. I like that. I was just taking notes on that. That's new to me, man. Thank you. I
Yeah,
appreciate it. All right. Ready for number two?
let's go. Let's do it. Yep.
All right. Number two. Homes with assumable mortgages must be a primary residence. True or false?
So false. Under a very similar, that we tied these two myths together because it goes into kind of what we just talked about a second ago. So under most circumstances, and when we say most circumstances, so we have VA, FHA, and USDA properties are all assumable. Most of the time, it's 99% of assumable mortgages are going to be either VA or FHA. In fact, I just looked this up on AssumeList, our website right now. We have over 2.3 million properties searchable on our platform across those three loan types. Of those 2.3 million, only about 7,000 are USDA. So 99% plus are either VA or FHA. So we're going to just focus on the answer to this myth based on where the predominance of assumable mortgages are. For all FHA homes, if a buyer were to assume an FHA property, that must be the buyer's primary residence. The FHA mandates that all FHA loans, at least when they're purchased or if they are assumed, they must be owner occupied. The caveat for VA is and this is where kind of tying into what we just talked about, VA, it doesn't have to be a primary residence. So remember we talked about there's two scenarios in which a buyer can assume a VA loan. Scenario one, they use their own entitlement, and we do what's called a substitution of entitlement. So the buyer uses their entitlement. Scenario two is where the buyer uses the seller's entitlement. So the seller's entitlement stays with the home. Under scenario one, if the buyer uses their own entitlement and they substitute it with the seller's, under that scenario, it must be the buyer's primary residence. Scenario two, if the buyer assumes that mortgage and the seller's entitlement stays with the property, then it can be an investment property and it does not have to be a primary residence. It would be no different than if the seller decided to just rent it out. They lived there for a couple of years and they decided to have it become a rental property, because there's nothing saying that a home can't be a rental property eventually. It just means at the time the home was purchased, the VA rules state that it must be a primary residence with the intent to live in it for a year upon the time of purchase. But that rule only applies for new VA loans. So if you're taking out a new loan, or if you're assuming a loan using your own entitlement. If you're assuming a loan and leaving the seller's entitlement in place, that rule does not apply. And in that scenario, there's no requirement for that property to be a primary residence. And that's why we have a lot of investors right now who really want to find assumable homes that they can convert into rental properties, and they're buying them all over the country. They don't have to buy them. They don't have to live in them. They don't have to buy them to live in them, as long as the seller is willing to leave their entitlement. We find, maybe about a quarter of sellers out there, for whatever reason, have no need for their entitlement in the future. Maybe they're retiring, maybe they own another home, maybe they have enough equity where they're going to buy their next home cash, so they don't need their entitlement again. Or in some cases, maybe they're elderly and they're going to move in with family once this home sells, and so they have no need to buy another home. So any of those circumstances really kind of create those opportunities for those buyers to come along, leave the seller's entitlement in place, and those properties, of course, can be investment properties, and there's no requirement for it to be a primary residence.
I like that. That's cool, man. I didn't know that as well. Very good. All right, so
Great.
far you're 2 for 2. I didn't.
2 for 2. Yeah.
All right, number 3. Closing costs are the same between a new loan and an assumable mortgage. True or false?
False. Yeah, so by and large, closing costs are almost always less for an assumable loan versus a new loan. Obviously, a big part of that is no origination fees, right? There's no new loan being generated in this process. You're just taking over what's already in place. So there's no lender charges, no origination fees, none of that stuff. You do still have to pay things like state and county transfer taxes, because of course the deed is still changing hands. And so the state and the counties are going to get you. They know that there's property moving around here. So they're going to still collect those taxes at settlements. You can expect those to be the same. But in addition to no lender fees, the other thing that's typically not charged is an appraisal. There's no appraisal for an assumption loan in 99% of all cases. So you're going to save another $600 there.
That's cool.
Yeah. Bonus. Yeah. And then for VA loans, when you get a new VA loan, there's something called a funding fee, which can range anywhere from like 1.5% to, upwards of 3 or 4%, depending on things like how much your down payment is and how many times you've used your VA eligibility. But if you're assuming a VA loan, the funding fee is only 0.5%. So greatly reduced, regardless of whether or not you're a veteran. It's a pretty minor charge.
That's good.
And then the last thing to know, this is just more of a side note. So it used to be, there is usually an assumption fee charged by the servicer. And that was always capped at a few $100s that they would be allowed to charge. I did just see a note this morning from a lender friend of mine. I speaking of things I need to dig into and just haven't had time today yet, but I read that the HUD is going to allow servicers to increase that fee to up to $1,800 for assumptions. So it is, that allowable fee is going to go up a little bit. So closing costs will increase. That said, I think it's probably a good thing, because one of the big challenges with the servicers so far has been there hasn't been a financial incentive for them to process them quickly. And now that they understand that consumers want these, they're starting to dedicate more resources and personnel to them. And they've got to figure out a way to cover their costs, right? So if they can find a way to do that and get these done in a more efficient manner, I think that's going to help everybody.
Wow, I like that.
I got
Yeah.
two additional comments on that. One, I think that HUD claim, I believe it's only going to apply to FHA assumptions. Because the VA actually issued a circular, don't quote me on this, it was either February or March of this year, which reiterated the VA's policy that lenders are only, or servicers are only allowed to charge a maximum of $300 processing fee to process an assumption. And they just reiterated that policy a month or two months ago or so. So if the processing fee for the HUD, I think that may be limited to just FHA assumptions. So keep
Makes
that
sense.
in mind. And then the other point, I'll just add on to Bethany's long list of ways in which assumption purchases have lower closing costs. There's another big one, and that is anytime a buyer takes out a new loan, they're typically required to obtain a lender's title insurance policy, which is a pretty substantial cost as part of your closing costs. It could be $2,000 or $3,000 of cost tied to or added to your closing cost. Well, because that buyer is assuming that loan, they also assume the existing lender's title insurance policy because that loan never changes. The terms of the loan remain intact, which means the title insurance policy also remains intact. So that's usually about another $2,000 or $3,000 of savings that an assumable purchase buyer receives when they go through that process.
Do they still have to then pay the difference if they're getting a separate loan for the other amount then? So they're assuming
They
a
assume
loan.
the first mortgage, yes.
They're getting a second mortgage, then they have to pay for title and all that.
Yeah, so once you bring in or once you factor in a second mortgage, then everything we're talking about changes because now we have an entirely new loan origination that is now kind of part of the picture. For the most part, we generally try to advise agents and our own clients to the extent possible. You really want to try to assume a mortgage, whether it's VA or FHA, using available cash to cover that difference and avoid at all possible the need to take out a second mortgage. It does complicate things in a couple different ways. One, it adds more time to the closing. Two, it often adds a little bit of risk because now the second mortgage, the primary lien holder, the primary assumable portion, has to approve the second mortgage, and not all servicers allow second mortgages to be issued. So it's not necessarily a decision that the buyer can make based on financial qualifications. It actually has to get run through the servicer to see if not all servicers allow second mortgage to be issued. So we generally try to advise our clients to always, come up with enough cash, or let's search for properties or filter properties based on the available cash that you have, and look for those homes that you can, you meet those requirements based on your available cash. And so what's really cool about AssumeList is you can search for assumable properties based on down payment. So you can filter based on the cash gap and only view those properties. And so it makes it a lot easier to find those homes without having to necessarily go down that path of a second mortgage unless it's absolutely needed. And then we have to do some additional homework to one, what are the requirements for that second mortgage? Usually a second mortgage does require now appraisal. You have to take out additional closing costs. All those things kind of go with it. And of course, the servicer has to be willing to approve that second mortgage.
Got it. Makes sense. Makes sense. All right. Anything to add on that, Bethany?
That's everything.
All right. Thank you for answering that too. I appreciate that. So if you have questions, put them into the chat. Bethany's attacking them and answering them, or we're going to answer them live. All right. Another one. Ready?
Go for it.
It takes forever to close on an assumable loan purchase. I think that one was the very first one we tackled on the very first webinar we did. So true or false?
Well, false. There are some horror stories out there. In fact, I just got an email this morning from an agent in California who said that she is working on an assumable loan that's taking upwards or in excess of 90 days, and that is unacceptable. So the VA has largely solved this right now, and they issued a circular back in December of 2023. So it's going on about 5 months or so. And we'll post the name of the circular in the chat to make it available. And what we'll do is I'll make sure once I'm done talking at this point, I'll make sure that's posted and people can pull it up. The point of this circular is to force, it's a directive, the VA has issued a circular, direct servicers must approve VA assumptions within 45 days. And in fact, many servicers, I know as I speak with agents around the country, they have, I'm not going to name servicers by name, but I will say that there are many servicers now who are actually completing assumptions within 30 days. So the
Oh,
timeline
nice.
to get VA assumptions approved is going down significantly as a result of this VA circular. It used to be 3 months, 4 months, 5 months. But the VA has mandated they must now be within 45 days. And there's teeth behind that if they can't comply with that requirement. To include, the VA has already stated they are willing to zero out that government guarantee on that loan, which servicers certainly don't want to happen. Additionally, there can be fines imposed, legal action against those servicers who don't comply, referring them to the Inspector General for audits and other kind of negative consequences that really the servicers don't want to have to go down that path. So they, for the most part, are hiring staff and bringing on board people to help ensure compliance with that 45-day rule.
That's good.
That rule doesn't necessarily port over to FHA assumptions. So from the servicers that I speak with, I'll ask them what their timeline is for VA loans, and they'll say, 45 days or 60 days. And it's really 45 days from the date the buyer submits their loan application. It's not 45 days from the date of contract ratification. So just make sure you keep that in mind. It's from when the buyer submits their loan application to that servicer. And as we all know, it could take a week or two. Once you get a home under contract, the seller has to contact the servicer, inform the servicer who the buyers are. Then the servicer will reach out to the buyers, or the buyers can call in and say, hey, this is so-and-so. We just bought this address. We need to submit our application. They'll be presented with a link to submit their application. So that there's a couple of days, maybe a week or so to get all that set up. But once the buyer submits their application, that's when the 45-day window begins. And there are no exceptions to that rule. The VA has mandated that servicers must comply. FHA doesn't have a similar document in place that I'm aware of. So for the most part, we're seeing FHA loan assumptions still take a bit longer. Since they are hiring more people on their staff, they are getting better at it. But you can expect probably about 90 days for an FHA assumption and 45 to 60 days, give or take, for VA, including the time to get set up with the servicer from the time you get ratified. So much better. The trick with all assumptions is buyers and sellers' timelines dictate what makes sense. So if a seller says, hey, I've got to close in 21 days, even though that home may have an assumable loan, they may not be interested in taking that offer. And likewise, if you've got a military family that, they're inbound from their last duty station and they've got their household goods showing up in 28 days, probably not a good option to pursue an assumable mortgage, because they may not have closed when they're, trucks showing up to deliver their goods, and it just creates complications. So always be mindful that assumable purchases take a little bit longer than a traditional home purchase. However, that's getting much, much more efficient with these new rules.
I like that. Thanks for clearing that up too. And that is important. I don't think we're so used to working in timelines of 30 to 45 days all the time, right? That sometimes we don't put that into perspective, and that's important. All right, 2 more. Ready? 5, number 5. There are no benefits to sellers in allowing their loan to be assumed. True or false?
False. Sure. Absolutely. Yeah. So this is, I think, when people say this, I think that's like more the fear talking than anything, without understanding what buyers might be willing to do in order to achieve this benefit. So, if you've got a buyer and you walk them through what they're going to save in the first year alone of owning this place with that assumable rate, the odds are they're probably going to be willing to offer a little bit more in the sales price, knowing like, hey, I'm gonna achieve this back in the amount of money I'm saving every month within the first year of owning the place. So you have to recognize that about the buyer's mindset. They know they're getting a benefit that as it multiplies month over month over month in their years of ownership, is going to save them a ton of money. And so the upfront cost to them, they could be willing to offer you way more than the asking price in order to take advantage and kind of exchange value in that way. And the other thing I think agents should be cognizant of, especially as we're headed into what is, for a lot of us, a slower time of year. You know, when school's let out here, the activity really starts to slow down. And then you get into the winter months. And if you've got a seller with an assumable loan, or you're in a market that's maybe not as hot right now, you know, longer days on market, fewer offers, that assumable loan might be the difference between you getting an offer and not getting an offer. So we've got a situation like this right now, actually, with a buyer that she's under contract in a part of the city that frankly, things don't move very fast. You know, average days on market, it's like 45 to 60 in a lot of cases. People are negotiating off the sales price in almost all the circumstances, but that seller has an FHA assumable loan, and they did the smart thing, which is they advertised that.
Yeah.
And instead of sitting around for 2 months, they got 3 offers the first weekend. And instead of taking less than their asking price, like all their neighbors are, they're getting full asking price, no seller subsidy, and they're closing on a timeline that makes sense for them too, you know, because they have the time to play with. 60 days, 90 days is fine with them. And they're going to net, you know, who knows, 10, 15K more potentially as a result of being willing to make that trade-off. So it can be hugely beneficial for sellers as long as the circumstances make sense and you as an agent are not scared to advertise that benefit, because it can be big for them.
Yeah. I think that's the key, being aware, right? So that you can talk about it and understanding it. That's why I love these, because it really helps people listening in. All right, ready for the last one?
Let's go for it.
All right. So before I go to the last one, first I want to thank everybody who's jumping on and listening, because a lot of this information you're going to be able to take back to your clients, and more importantly, you're going to be able to check to see if the property is assumable, and that's super valuable. Just to the last point that you made there, Bethany, a lot of the times it's just knowing and being aware that these properties are assumable. That gives us the edge. And sometimes we forget that it could be so small in that advertising, right? So I just wanted to bring that up. All right, last one. Second, mortgages cannot be used with an assumable purchase to close the cash gap. True or false?
It is false, but as we talked about earlier, there are some caveats. So for the most part, you know, we all have our buyers, our clients have some limitation in their available cash to cover the down payment of an assumable mortgage. You know, assumable mortgages sound great if you can find one where the numbers make sense. But homes have appreciated so much in the last 2, 3, 4 years, really kind of this post-COVID era. I know, like in our home market in Northern Virginia, just the past 12 months, we've seen 10% year-over-year appreciation, massive amounts of appreciation. Homes, military families, for example, you know, stationed at the Pentagon or Fort Belvoir and the nearby bases where they bought just 3 years ago, are sitting on $150,000, $200,000 of equity in 3 years. It's unbelievable the amount of equity homeowners have just in a few short years. And so they're, you know, they may be sitting on a home with a 2.5 or 2.25, I saw today, 2.25% interest rate, which would cut somebody's mortgage payment in half relative to taking out a new mortgage, especially if you're looking at a $700,000 or $800,000 or $1 million property. You know, you could be looking at $3,000 a month in savings in interest. So because there's so much equity, you know, there is a place for a second mortgage, and we do encourage those options when they become available. So keep in mind, not all lenders, particularly the traditional lenders that you, Tristan, or we work with on a regular basis, most lender partners of agents don't offer second mortgage options. You really have to find a specialty lender who caters towards these, and sometimes they're portfolio loans or loans that are held inside that bank or inside that lending institution. So a lot of these brokers who originate new loans, the originators often don't offer second mortgage options for these types of purchases. So always connect with your lender first. Hey, do you offer second mortgages? You may find most of them say no. There are lenders out there, and we can certainly recommend a few if you're interested, that offer second mortgages. The catch to all this is it does add a layer of complexity for an assumption purchase. Usually the best scenario, so I'll give a use case. The best scenario to use a second mortgage, obviously it's whenever a buyer doesn't have enough cash to cover that cash gap on their own. They're still going to be required to put a minimum of 5% down. At least the lender that we work with that offers second mortgages does require a minimum of 5. I've seen some lenders require a minimum of 10%, and some even require a minimum of 15% down. But generally speaking, between 5 and 10% down payment. But remember, it's going to add more time to the closing because you have to get the second mortgage approved. The second mortgage holder will require an appraisal, make sure there's enough equity in the property to cover to cover that debt. And then it has to get run through that primary lien holder, who is the servicer on that assumption loan, whether it's a VA or FHA. And that primary lien holder also has to approve that second mortgage, has to allow that second mortgage to go through. So usually when you're looking at using a second mortgage, it's very difficult to find a seller willing to go down that path if the home was just listed in a hot market, spring market, in a really desirable neighborhood, in a really nice home where there's a lot of interest. Probably not going to be the best use case for a second mortgage. What we find them to be most used, or when they're most used, is scenarios where, say, the home has probably been on the market for 2-3 weeks. Buyer is flexible on closing timeline. The seller is probably a little bit flexible on the closing timeline. And so, if we said 45 days to 60 days for a VA assumption without a second mortgage, you can factor probably another 2 weeks to 3 weeks to include the need of a second mortgage and getting all the appraisals and closing documents and additional documentation through the system when you have a second mortgage. So usually these are homes that maybe they haven't sold in the first weekend. Maybe they've been on the market for 2 or 3 weeks. Seller just wants to make something work, so you offer them an option with a second mortgage, and then you go through that process. So yes, they can be done. Yes, they are helpful. They are a little tricky because we just kind of talked through that, and the servicer specific. Some allow them and some don't. But they are another tool in the kit bag, right? As agents, if you're working with a buyer, just keep in mind that potentially is an option if the circumstances all bear out.
Got it. And I put in the link AssumeList.com frequently asked questions, because some of the things that we talked about right now are going to be answered in there as well. So jump in there, take a look, and obviously this is brought to you by AssumeList, and the pricing is on there, resources. Guys, what other areas are you opening up soon? I know the last time we were talking, you said it was going to be parts of Texas. Where are you at now?
Yes. All right. So I just posted our exclusive landing page for Lab Coat agents. There you'll see a nice, great photo of Tristan with a smile on his face. And then we do offer 15% off subscriptions for our Lab Coat agent friends. And then we're working on right now, Texas. We just on the cusp of getting approval. We're going to initially launch in San Antonio, and then we're going to work into Austin next, then Dallas, and then Houston. So we'll kind of cover the 4 major cities, hopefully within the next 30 days. It's kind of like the timeline we're looking at most 60 days. There's some compliance things and obviously MLS rules that we've got to work through, but we're just about there with San Antonio. That'll be first, and that's Texas. Then we're working on North Carolina, so the Charlotte area and surrounding Canopy MLS, so inside the Canopy MLS market area, as well as the Eastern Carolina, which is I know where a lot of the military bases are. So we'll cover the Eastern North Carolina market as well. We're working on that within the June timeframe as well. And then we're also the next big market is going to be Atlanta. So we're going to be launching in Georgia. Huge think Atlanta is the 4th largest state in the country with assumable mortgages. Texas being number 1.
Oh,
Florida is number 2. California is number 3, and Georgia is number 4. If you look at the total volume of assumable mortgages statewide, Georgia has the 4th largest concentration of assumable mortgages in the country. I think there's somewhere around 4 or 500,000 properties with assumable mortgages. And I set my criteria. These are assumable mortgages with interest rates of less than 5%. Because if it has an interest rate of greater than 5%, just because somebody bought a home a year ago with a 6.5% interest rate, I don't really care that it's assumable. Most buyers don't consider that a viable option. So we really look at homes that have assumable mortgages with interest rates of less than 5%. So 4%, 3%, 2%. That's the range that we find that most buyers get excited about. And there are hundreds and thousands of those in Georgia. We're going to start in Atlanta and kind of work our way out. It's not on our website yet, but we did just recently launch in Jacksonville, Florida,
oh,
as
nice.
well as West Palm Beach, Fort Lauderdale area. We're live there. And we're right on the cusp of launching in Miami-Dade County as well. So we'll be live in Miami-Dade, hopefully within the next 2 to 3 weeks for Miami-Dade.
Nice. And I'm taking a look at your site. I know you said it's not on here yet, but this is what it looks like for those wondering what areas they cover. I'm in California, so that looks really nice for me, especially because I'm in Southern California. So that's
Yep.
even better. But look, you can take a look at the states up here, really easy. And you said Florida, but you don't have those areas that
Yeah,
you just.
that map's not been updated, but we are live in Northeast Florida, in like Duval County, Jacksonville area. So we are live there, and we are also live in West Palm Beach, Fort Lauderdale, kind of Boca Raton. So we're live there right
Over
now.
here.
And then the
Yeah.
last one is the county in the south tip there, the Miami-Dade. We're just working on the final MLS approvals. We'll be launching
Perfect.
there in hopefully the next 2 weeks, and then we'll update that map to reflect all those new locations. So a little bit of a
Awesome.
soft launch initially, but yeah, we're growing. We're growing fast. We're growing furious. We are live, as you saw. I mean, a lot of the major markets, so Colorado and Arizona and Nevada, of course, up and down East Coast, Virginia, DC, Maryland, Delaware, New Jersey. So yeah, we're growing. We're trying to find those really big population centers where we get a lot of bang for the buck, where a lot of people have been submitting the waitlist inquiries, and we are trying to fulfill those based on kind of popularity first, and then we'll kind of work our way out. It's not easy because every market that we launch in, we have a live connection to the MLS, and that's what
Mhm.
makes us unique to some of the other tools that maybe, that usually there's a lot of lag in some of the data, where we are very keen on our data being very current, live connection to the MLS. Subscribers can set up alerts or notifications. So if you're an agent, you're working with a buyer, if you want to know when a property hits the market with an assumable mortgage, you can set up an alert and it'll automatically notify you or notify the agent or the client that you're working with. So some really
Easy.
cool tools that we built in. Let alone, we haven't talked about, you can create branded landing pages. So you can share a
Oh,
link we
yeah.
talked about this, I think, last time,
Last time.
branded to your name with your contact information, and share that on social media, and then receive leads based off of that shared link that you're promoting. Could be your own listing, or it could be, a listing in your office. It could be a listing that you just happen to like because it's in your neighborhood and you
Yeah.
want to find a buyer for it. So you can share that in social media and then generate leads from it. So a lot of really cool tools that we offer to agents. That is the only place you can get these tools to
That's
support
true.
your business is from AssumeList. So
Question from Gail. Are you coming to Illinois?
we are in Illinois right now. We're in Chicago and all of central Illinois. So the entire MRED MLS, which is covers about 3/4 of the state right now. So if you're in like Peoria, I think there's another MLS out there. We haven't launched in the western side or the extreme southern side of Illinois, but we are in central and northern Illinois, to include the entire area surrounding Chicago.
Perfect. And Shawnee wants to know how a seller can go through the process of allowing a buyer to go through an assumable loan.
Bethany, you want to cover that one?
Yeah, sure. So, we think the most important first step there, Tristan, is to advertise it, make it known that the seller's got an assumable loan, who they're willing to let it assume to. So if it's a VA loan and they only want it to go to another veteran so they can get their entitlement back, state that up front for people, let them know how great the interest rate is, give agents the details about the monthly payment and things of that nature. So advertising is really helpful, because then even if that consumer or their agent is not on AssumeList, they can still see, hey, this is an option for you. And then once you actually, ratify a contract with that buyer, really the first step that happens is the seller reaches out to the servicer and says, hey, I am going to let my mortgage assume in a sale. We have a ratified contract. We want the assumption package. And from there, the servicer will then reach out to the buyer that you're under contract with. They'll get them a copy of the assumption package so that the buyer can, it's basically a loan qualification package, just like you'd fill out if you were getting a new loan, because they're going to ask for social security numbers to run credit, income, assets, things of that nature. Once the buyer sends that back, that starts the clock on that 45-day timeline, at least for the VA loans. And the servicer is going to review it and put it through underwriting, just like they would again for a new loan. And in there, there's, just like with a new loan, there's always questions that the underwriters ask. They go back and forth. Sometimes the seller has got to step in to answer questions as well. But generally, it's not much different than getting a regular loan, from the standpoint of you're working with that servicer to be sure that you're financially qualified to receive a loan from them. Just, it's not a new loan, it's an existing loan.
Another fun fact, Tristan, I know we talked about this, but servicers are not allowed to deny assumption packages. Specifically with VA loans, it's a guaranteed government entitlement, so it's a benefit to the veteran. So the only way an assumption can be denied is if the buyer doesn't financially qualify for that loan. But the servicer cannot say, hey, we're full, or we're not taking any more assumption packages. We're not considering them because we're too busy. Wrong answer. They have to comply with that rule, which means all assumption packages must be processed. They don't have a choice. It's a guaranteed government entitlement. The only obviously reason why a buyer may not get it is if they don't meet the financial qualifications.
Yeah, we might want to do a webinar devoted to kind of like navigating an assumable offer, Tristan, because I'm already, I can think of 5 more things now, and I know we're already past time, but that's a great question. And maybe one of our next webinars is to walk people step by step through that process.
I agree. I'm putting up a link to, if you have questions, to AssumeList. At the very bottom of that page, it says get in touch. They can answer any questions you have, whether it's about a list of lenders that accept seconds or that do seconds, or anything else. Just put those in there. They can gladly answer those. Mike, thank you so much, man. I appreciate it. Thanks for doing this. Shawnee, yep, you're welcome. We got you. And I like the idea that Bethany had of expanding and doing that. Some great questions there. Thanks, Mike.
We are actually, can we tee up the next session? So our next session, we are going to bring on board our in-house lender partner, and we're going to talk through all of these questions about second mortgages, down payment requirements, timelines, everything to do with loans, because that's the biggest piece that questions that buyers have is, how do we get through this loan assumption? What's their lender requirements, underwriting requirements, credit score requirements, second mortgage questions. All of that will be discussed in our next monthly session with you, Tristan.
That's a good one, man. That'll create a lot more clarity so that we know what that looks like. I like that a lot.
Awesome.
Thanks, Mike. Thanks, everyone.
Thanks, everybody.